Why Tesla's stock will keep crashing. We will talk about that today. Happy Tuesday, everybody. It feels like a Monday, but it is not Monday. It is Tuesday. We are back from the long weekend. Hope everyone had a great 4th of July weekend. Let me know in the chat how you guys celebrated. You know, do you go out on a lake? Were you on a beach? You have some barbecue? Were you with some family? Let me know in the chat what everyone did over the weekend. We will talk about what's going on with the overall markets today, kind of any updates we've had on crypto over the weekend. We should be joined any minute by Mr. David Green. We'll be doing some live trading with him. And then at about 12:30, we will have Rob Roy from Wealth Builders HQ to talk about some of the options trades that Rob has been making. So go ahead and smash the like if you're here. Let's roll that intro and get started.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wujasek from Trend Spider. We have a
breaking news. All right, guys. So off the top, I want to talk about Tesla stock for anyone new here. We spend some time on Tesla usually. Tesla is still one of the most searched for and read tickers on Benzinga Pro. So ever since I've been at Benzinga, about a year and a half, through the COVID crazy 2020 markets where everything was running, Tesla was, of course, one of retail's favorite stocks. And right now, a lot of people are watching Tesla, and I'll explain why. So essentially, and so we're looking at a daily chart here. Let's zoom out, go back, give us a little 2-year time horizon to look at. So this was heading into COVID. So before the markets really took off and we had, the crazy stimulus coming from the Fed, buying assets and pumping money into the stock market, this was before all that. Rates were pretty low, so it was a good environment for stocks. I mean, the stock market was making new all-time highs seemingly every single day at this point leading into the COVID crash. So if you look here, this is just Tesla stock, December 2019, and this is split adjusted, $66 a share. By the time we got to February 2022, $165. So it had gone up more than 100% in a little bit less than 3 months here. So Tesla was already on this crazy run. And then like everything else, this is right where COVID hit and the whole stock market crashed. So Tesla went from 180 a share, again, split adjusted, down to 66 in March 18th, 19, where we kind of bottomed out. And you can really see just the insane moves that Tesla had been making all throughout those COVID markets when, of course, rates were basically zero. Retail traders were coming in here and pumping extra volume and into the markets and into Tesla in particular. So we had this run from $60 at kind of the bottom of the COVID market all the way to highs of 900 came off here, made new all-time highs, got above $1,200 a share. You kind of have this double top head and shoulders pattern that you can see here. And then we crashed for a while. And then in early April, late March, we had this another leg up, almost got back to previous all-time highs, but never quite got there. So rejected again right here at this kind of $1,100, $1,200 level. And we have now since kind of found this range. So if you look here, we hit bottoms of about 630. This was, just a couple months ago in May. Ripped back up to about almost 800. So we've been kind of just in between this 600 and 800 range, barcoding around. Now, a lot of people are looking at Tesla and saying, oh my God, look, it's down, more than 50% from its all-time highs of almost $1,250, $1,300. We're now down to 660. This is a good time to buy it. The price is cut in half. I would say, and this is not me, this is not financial advice or anything like that, but my personal prediction is that I do expect Tesla to continue to move lower. And there are a number of different factors that we'll talk about. Over the weekend, Tesla announced deliveries numbers, which came in line with expectations, which is honestly very, very impressive considering the macro outlook and the kind of different supply chain issues that even that Tesla was able to meet those expectations, I think is actually a very good sign. But the problem is is Tesla. When you look at its stock, Tesla stock has done so well because of its growth aspect and its growth value. And that's where I think this story gets interesting, is where now Tesla has grown and is so big, and it'll still be growing. But I don't think that it will be able to maintain the growth that it's had over the past couple years. And thus, the stock won't grow or quite appreciate as much. The other thing that I wanted to look at is the VIX. So I'll look at the VXX to look at the VIX. It doesn't exactly perfectly track the VIX, but it does a pretty good job. And so we're actually we're looking at on the daily here. I mean, this was in COVID when shit really hit the fan, to put it lightly, and no one really knew what was going on. The VIX shot up, and we've been kind of on a steady decline since then. But if we zoom in over the past few months, we can see like here was in March, one of the days where we were trading off big time from the Russia-Ukraine stuff. Basically, my prediction is that before this bear market bottoms, before we truly capitulate, I think we need to see this VIX go higher. I think we need to see some more pain. I think we need to see some more sell-offs in some of these equities before we truly bottom out. And I could be completely wrong. And if I'm completely wrong, then I'm not mad about that, because that means, oh, maybe we already have bottomed. Who knows? But how Tesla and the VIX is related, that as the VIX rises, I expect Tesla to fall. And then, if we get to that point where like we do get that true capitulation, like maybe people who have bought Tesla on leverage and margin get margin called and they're forced to sell, because that's really what you want to see as a sign for, a bottom, is that when people are forced to sell, not selling because they want to sell. And that's basically, so far in this bear market, from what I've seen, and this is of course outside the crypto outside the crypto industry, most selling has been very meticulous. Kind of, we can sell this at this price, we're already up 50% on it over the past year. It hasn't really been people selling because they have to sell. And I think we do need to get to that point before you get that turnover. And again, if I'm wrong, I'm happy about being wrong. But that's how I'm positioning myself, is to be ready for if Tesla, and then of course, Tesla is now in the S&P 500 and in NASDAQ. If those things come down with Tesla coming down, then I'll be in a position where I'm not super upset that Tesla drops another 20-30%. I see some people in the chat talking about energy. Yeah, I got into this drip trade a few weeks ago. I think bottom ticked it, but I already sold it for 15-20% or whatever, just because in this environment, like, it's hard to find winners. I'll take my winners and run. But I mean, this thing has been on an absolute tear. Let's look on this on a weekly chart. This is the drip, the bearish fund from direction. So yeah, I mean, in 1 week, up 52% on the drip, the next week up 8%, and then another 15%. And let's just compare that to the XLE, which has basically been on a straight downtrend over the past few weeks. And that's why it's tough. I mean, look, people are always out here saying, the trend is your friend. You want to buy into strength. But if you bought XLE up here, you bought oil and gas companies after they were already overextended, or after they were already up 3 months in a row or whatever, you could have got burned. I mean, look, the XLE went from $93 to $68 this is June 6th. This is literally a month ago. It has gone from $90 to $68. It's almost 25% in a month. And, we can look at individual oil and gas companies. Like Chevron's down 4.5% today. This is Chevron. This is a Dow company. This is a company that's not supposed to be this volatile, move this much, but this is exactly what happens when you get overextended. I mean, look at this move up, right? I'm not even the biggest chart guy ever, right? But if we're just going to look at here from the COVID bottom, all right, you're on this kind of steady uptrend climbing. What happens here? Just almost straight up, almost straight vertical up. Instead of going up on a slope, it almost goes straight up. Yeah, okay, Chaz, it's hard to let the winners run. It's like you're up 15%, you just want to take them because everything else seems to be losing money. So now we've basically filled this whole gap. You can see we gapped up, traded sideways, broke out, made new highs. traded off and then are back now to almost exactly on that support level where we were before we had that big leg up. So Chevron to me, I missed out on kind of this whole trade on the run up during the Russia Ukraine things, but I was happy that I didn't FOMO buy. I haven't made any money like shorting it here. I did buy the trip and made some good money on that, but that was just more of a quick like swing trade. Nothing too crazy. Okay, Chaz saying he shorted UCO, the Bloomberg crude oil ETF on let's see, at the exact high, ended up covering it too early for 20% too. Yeah, and I mean at the end of the day, okay, Chaz, it's easy to beat ourselves up now saying, oh, I should have held this. I should have held this position longer. I would have made more money. But, that old adage, that old saying is very true. You can't go broke taking profits. I mean, if you consistently can get 10, 15% winners, you're going to have a very long and very successful career in investing versus if you're just hitting home runs every once in a while, which is kind of my basically my trading strategy is hitting home runs every once in a while. But that's how I was explaining this to someone over the weekend. My trading strategy, I have my long-term investment portfolio, and like my Roth IRA, where I am doing all that. And then my Robinhood account where I'm trading options and it's more just for fun. And so my Robinhood account is where I'm really going for home runs. And that's what I would encourage. If any of you guys are options trading or doing any YOLO trades like that, I would encourage you to keep those accounts separate, right? Have your long-term retirement investment account and then also have your YOLO account. Like it's fine. And then obviously in my YOLO account and the one that I'm just trading options with, I have a lot less money in it. It's just like, it's almost play money for me. Whereas my real investment account, like I need to keep that I need to keep that sound or else I won't be able to retire ever. Speaking of hitting home runs in investing, I was reading this. I don't know if you guys have been following, but Bill Ackman's been going not crazy on Twitter, but he kind of, first of all, I don't think Bill Ackman knows how to make an actual Twitter thread. Oh no, he did. Okay. For some reason on his profile, it wasn't showing up as a thread, but then when you go to it, it is. So I wanted to talk about this because Bill Ackman, he's been a famous guy in investing for a while. He's one of these guys that has been had like wicked success in certain trades, in certain things, and then outside of that, sometimes been off the ball. And he's kind of just had this reputation as someone who will hit a big home run and then strike out a lot for like 2 years in a row, and then hit another big home run. So, he had the Herbalife thing. He had during when COVID crashed. He actually made a lot of money shorting the market before COVID crashed the market. And people were upset because he came on CNBC and was basically like, oh my God, this is the end of the world, all while having a short position, thus, creating more fear, causing more people to sell. And kind of the same thing is happening right now. So if we back up, if we zoom out, if we go back like 5-6 months ago, when Mr. Hot Stocks Luke joins the show on Thursdays, the past few weeks, we've talked about Netflix a few times because Netflix is one of these stocks that has just gotten hammered and crushed to the point where it looks like an attractive investment, not just for guys like Luke or guys like me, but guys like Bill Ackman that run Pershing Capital. So Bill Ackman, it was 4 or 5 months ago, put 20% of his AUM, his assets under management, into Netflix at an 80 PE. He lost a lot of money on the trade in like a quarter, got out, which I really commended. It's hard sometimes as retail traders, if you're managing someone else's money, it's hard for all of us to admit sometimes when we're wrong, you make a bad trade. But Bill Ackman did a good job cutting the loss, getting out of the Netflix trade because it's continued to move lower. But basically, he went from feeling good enough about the macro outlook to invest that much money into Netflix at an 80 PE, at a very expensive valuation, a very expensive multiple. And then the trade doesn't do well. He gets out of it. And now he's like doom and gloom, as bearish as you can get. Over the past 2 weeks, rates have declined dramatically due to fears of a recession. Friday's move was particularly stunning for the scale of the move and for the degree of intraday volatility. I put forth here a theory of what's going on the risk of a recession. Recession is defined as blah, blah, blah. It is more difficult for nominal spending. So basically this whole thread He's critical of the Fed Reserve, which I agree. I have been also been critical of the Federal Reserve, but um, so we have a supply, not a demand problem. This does not seem like a setup for a true economic recession, regardless of the favored definition. So why have rates um, become interestingly strident about the need for aggressive tightening to bring back inflation down to 2%? The answer, I believe, is largely due to some misunderstanding about what a recession is, but more importantly, technical factors that are driving volatility and a downward move in rates. Market participants speculating in the fixed income market, particularly hedge funds, often use enormous amounts of leverage because it is available and it allows one to make windfall profits if you get the trade right. The bet that rates would rise became one of the more crowded trades in history going into June 15th. So basically, everyone's looking at the macro environment. Everyone is seeing that you have these different data points that are indicating that a recession is more and more likely. So the common knowledge there would be, okay, the bonds have to come up because in recessionary times, bond markets tend to do better because they're safer than equities. So people rush to buy bonds when things are more uncertain. So the conventional wisdom would tell you that interest or that raising interest rates would create, bond yields to rise, and the bond markets would do well. Um, that hasn't really happened, and I've talked about that a few times on the show, that the bond market has actually been one of the things that's been seemingly not pricing in a recession. It's like everyone's saying recession, but you look at the bond market, and the bond market's not saying recession. And one thing you learn or one thing I've learned, which I would not have assumed really, um, but the bond market is actually like the equities market, the overall US stock market. Stocks make up a fraction of what the bond and fixed income market makes up. Like there's much more money on Wall Street in the bond market in the fixed income world than the stock market. That girl Tash is asking, what is a bond? So a bond is essentially a security that's backed by the government with a time frame, so a 10-year bond, and it'll give you a promised rate of return. So say, you buy a bond from the U.S. government that you have to hold, or you can't pull your money out essentially for 10 years or 20 years or 30 years. Um, and then you get a specific return. So you get 2% back over 10 years instead of if you buy a stock, you don't know what that return is going to be. So bonds don't have the same risk involved as equities unless of course the government or okay, like Christopher saying in the chat, corporate bonds. So say the corporation or government that's backing the bond goes under or goes bankrupt or whatever. That's your real risk with bonds. So otherwise it's very much a safer way to invest money. The problem is no one's really been into bonds over the past 20 years or so because interest rates have been so low that it's basically there's no real reason to buy bonds for 2% over 10 years if you can just invest in the S&P 500 and make 10 times that. Easy Mike, there have been moves in the bond market that have screamed recession, but if you look at the overall trend of the bonds, it's that they've been moving lower, right? If you go back to December 2021, I'm looking at TLT right now, we were at 150. We've been moving lower. And if you go back to 07, 08, bonds moved higher because people were wanting to come in there and buy the bonds. Then a lot of people right now are also anticipating interest rates to continue rising. But let's finish up here on the Ackman thread real quick, because basically my point here is that rates going up a lot soon. The sooner Fed quells inflation, the better. I just don't like Bill Ackman's gotten to the point where he's so famous and he's had success in the industry for a while. So people look at what he says, not as gospel, but as like something to take seriously. But I'm not really doing that here. I'm not taking this seriously for a couple of reasons. One, because he's saying the rates are about to go up like a lot more than people think, which I just don't think is true at all. So where was that part where he was saying that rates are going to go higher? Rates are going up a lot soon. The sooner Fed quells inflation. There's actually data points that show you that that's not the case. So let's go this. So this is one of my favorite Macro guys on Twitter, Macro Alf. He runs a Substack. He's got almost 200,000 followers. He's actually going to be coming on the show pretty soon. Let me try to find this tweet from him because it was interesting. Here, I'll find it this way. We'll just search bond market. Oh wait, here it is. I see it. Whoa, 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 whoa. Whoa, 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 whoa. Here we go. All right. So in the green line, we have the Fed dot plot. This is where the Fed says fund rates are going to be. And Tasha, whoever was asking what a bond is in the chat. So, whoa, dude, bond yields have risen. So when yields rise, there is less of a reason to buy stocks. Yeah, and that's what the Fed is trying to do when they raise interest rates. So Tasha was asking what a bond is. When the Fed raises interest rates, they're making the bonds more attractive to investors because if interest rates go to 5%, okay, now you can get a 5% return on a bond versus 1%. So if you want to so for the Fed who wants to quell inflation, a lot of that inflation is driven through, the stock market being frothy and there being a lot of money in the stock market. So one way to do that is to raise the interest rates for bonds. So then you have money going out of the equity market into the fixed income market, into the bonds, and it helps inflation. That is literally what the Fed is able to do by raising interest rates. But in the green line here, you have the Fed dot plot, so this is where the Fed says interest rates will be, where the Fed fund target rate will be. So the Fed is saying that in 2023, right here, the Fed rate will be above 3.6%, somewhere in between 3.6 and 3.8%. The bond market, Fed funds futures, is saying it'll be below 2.8, almost a whole percentage point. Almost a whole percentage point lower than what the Fed is saying. So that's where it's interesting here. Like looking at the bond market, I think you can really get a lot of clues. And because there's so much money in the bond market, all the big players on Wall Street are like making their money in the bond market, not in the equities market. And the bond market in terms of just overall money dwarfs the size of the equity market. The bond market's not going to get something like that wrong, right? They're basically saying, okay, the Fed is saying the fund rates are going to be here, but no, we don't really think so. And why would there be this big of it here? I'm going to give you guys I'll do a Windhorst impression. Now, why would there be this big discrepancy here between the Fed dot plot and the fund pricing Fed futures? So why there will be this big of a discrepancy, and this is my theory. This isn't factual. This isn't whatever, but this is my theory, is that I think Jerome Powell and the Federal Reserve understands that by even just signaling this, even just talking about this as the reality that the Fed rates will be up here, what does that do? That causes companies and investors to plan around that, to plan around the fund rate being here. And what happens when they plan around that and they start investing or running their company based on this, that fund rates are going to go up this much, that money is going to be this expensive, it slows down their growth, right? If you were going to say you're a private equity fund and you were about to make a big acquisition for a company that you own, you have a company in your portfolio and you want to buy one of your portfolio companies' competitors and merge them and create this big thing, you're going to be more likely to do that when the Fed fund rate is lower, when interest rates are lower, when there's more, when money's flowing more freely, when money's cheaper to borrow. So by just signaling this, by just talking about it, it causes companies and investors to question how they're going to invest things, how they're going to manage their companies, and really plan around that. And then what happens is the macro effect from that is then you don't even have the need for that because money isn't flowing around in the way that it was. You don't have inflation rising that way just because you have it in people's heads that the Fed rate is going to be this high. And then now they can say, oh, things are actually looking a lot better because all you guys out there, exactly, Easy Mike, liquidity dries up. Just by talking about it, it doesn't mean that like I don't even know where the rate is at right now. I think a little over 2% or something. So we're nowhere near this 3.7%. But just by talking about it, just by signaling that this is our plan, it is going to cause liquidity to dry up. And the bond market here is now kind of playing chess where they're saying, okay, we know some people are going to plan on this being the rate. So money's going to slow down. And then the Fed's going to be able to come out and say, okay, now we can turn the money printer back on. We can ease things. Now we don't need to actually go up to this thing. So that's what the bond market is saying. The bond market is saying they don't believe the Fed is going to have rates this high. Maybe that means that the bond market is thinking we're going to be in a lot of trouble over the next 6 months and that the Fed will have to cut rates from there. I don't know. I can't talk to Mr. Bond Market, but I can see what the Mr. Bond Market is saying, and it's the exact opposite of what Mr. Bill Ackman is saying. In that, that the Fed is going to have to raise rates even more than they've already said. Inflation, this, inflation that. The equity market has to crash. And Bill Ackman, I'm pretty sure I got to fact check this or whatever, but I'm pretty sure he has short trades open right now, which is also just where I'm not going to take Bill Ackman seriously when he's talking all this doom and gloom stuff while he has short trades out, especially when 4 months ago he was putting millions and millions of dollars into Netflix at an 80 PE. Obviously, he doesn't think the macro environment is really that bad, or else he wouldn't have done that with Netflix. He thinks it's that bad now because he has a short trade and he's seen an opportunity to potentially make some money. So, I don't know. I think we'll see. I think if anything, we'll see. Well, these next 2 months will be very important in terms of PCE and CPI, because if we do get some more signs that inflation could be coming down, then of course that lowers the need for the Fed to continue to raise rates. Let me just catch up on the chat real quick. So TJ Mosley saying if bond yields went to 5%, wouldn't that signal a recession? Yeah, I don't think we'll get to 5% yields without true recession ever. But yeah, and let me pull up on Benzinga Pro. So I'm just looking at the TLT here. Oh no, this is UCO still. Let's go to TLT. So here's what I think is interesting, right? If we look at this on a weekly chart and we zoom out to right. Okay, so in 08, you did have this kind of crash into the TLT during the recession, but you had this big run up. We haven't really seen, I mean, maybe this could be that big run up, but the fact that the TLT has just been moving lower and lower over the past few weeks, past few months, to me is signs that people aren't rushing out here to buy this. They don't want the 20-year treasury year bond ETF. So TJ Mosley, let me know in the chat, because I know you were saying earlier, whoa, dude, bond yields have risen. So when yields rise, there's less of a reason to buy stocks. Yeah, 100%. I agree. So if I'm getting something wrong by looking at this chart and seeing that it's down and saying that people aren't going to buy, because in my mind, and again, someone correct me if I'm wrong, but in my mind, if the bond market is moving lower and the US dollar is moving higher, that's showing that the markets are saying we're not, the US dollar does not do well in times where the United States is in a recession. We can go back out. This is the, oh shoot. Okay. So this goes back to 07. I mean, look at what the dollar was doing in 07, 08, just straight down. Look what it's doing right now, straight up. It's the exact opposite. So the fact that the Forex market and the bond market haven't really been acting as if there's a huge recession coming, I don't know. That girl Tash is saying there's a recession coming for sure. I don't know if we can say for sure either way or not. My prediction is that I think stocks will move lower before we come back up and really capitulate and get out of this bear market. But do I think that means you have to think about the stock market and the economy in two different things, because they're correlated and they're connected. But the stock market and the economy don't always have to do the same thing. So basically, I'm expecting more weakness in the stock market over the past couple months, especially because we're going to see a lot of the biggest companies, your Apples, your Teslas, your Microsofts report earnings this month, and I don't think they're going to be that great. So when you have all those biggest companies report underwhelming earnings and their stocks move lower, that's going to create the indexes, everything to move lower. So I wouldn't be surprised if we make new lows in the next month or two. but I don't think the economy is really at risk of an 07, 08 type recession. Um, right in wait, hold on, I'm catching up on the chat again. Shelly, be nice. That I don't do that. Shelly, Marley the terrier was bitten over the weekend by a dog down the road on his that smooshes a cat is mad. Christopher saying a skyrocketing dollar discourages large companies from doing business in the United States. Yeah, I mean, a skyrocketing dollar isn't necessarily great for okay. TJ Mosley saying bond yields and the TLT have an inverse relationship. So when bond yields rise, the TLT falls. So in 2008, when the TLT fell, what was the bond yield? I don't know. We can go back and look at it, what the bond yield was there. But the bottom line is that, right? Okay, if you think about it in kind of a binary situation, it's not this simple, but we can think about it in this binary situation. Investors are either going to want equities or bonds more at any given time. In times of uncertainty, bonds becomes more attractive. In times where the rates are low and the economy is doing well, equities are more more attractive. So the fact to me is just showing the check the Fred. Yeah, we can do that. But yeah, Tesla has made a nice rebound here. But yeah, basically my bottom line was in 08, 07, 08, when we had the big recession, something had to fundamentally break, right? You had to have these mortgage-backed securities. You had to have these credit default swaps. And you had to have these, subprime loans. Like the whole thing was kind of really like, if you watch or read The Big Short, you understand how it's kind of like a once in a lifetime type perfect storm for that recession. And I don't really think we have anything like that now. Like, I honestly think the biggest risk would be if Bitcoin and crypto just completely collapse. And even then, I think we would see that shake out throughout the equity world and on Wall Street, because at this point, a lot of banks and a lot of Wall Street players have exposure to it. But I don't think that really creates the same problems that we had in 07, 08. I could be wrong. There could be bigger problems that could break in 2022 than in 07 and 08. But from right now, from everything we're seeing, I don't think we have to worry about some huge 07, 08 recession. Yeah. Yeah, 08 it's completely different. And then that's why like people I've been seeing on Twitter, on FinTwit a lot, have been comparing this macro outlook to 07, 08, or even the 01 or 2000 .com bubble. And it's really not the same as either of those. We had, for the first time in 100 years, like a truly global pandemic in 2020 that is going to have supply chain disruptions throughout the world. On top of that, you have central banks around the world trying to figure out exactly how to navigate this problem, inflation, with monetary policy. So you have all this uncertainty with, okay, what is Europe doing? What is Japan doing? What is the US doing? And because of the situation we're in, the United States, a lot of people are going to be looking at what we're doing. So that puts even more added pressure on Jerome Powell and the Fed. And they have talked about their dual mandate for unemployment and inflation. They want to bring inflation down without causing unemployment to rise so much. We've seen what the pain in rising interest rates has caused, right? If you look at the tech layoffs, right? We've seen layoffs in Carvana. We've seen layoffs in Tesla. We've seen layoffs at Twilio. We've seen layoffs at all the crypto companies, Coinbase, Kraken, you name it. So basically, I think I think Powell and the Fed is willing to tolerate that, willing to tolerate some layoffs in some high growth tech spaces, but they don't want to see layoffs from companies like FedEx or Walmart or companies like that. So the Fed's dual mandate is to lower inflation without creating unemployment to rise a lot. Now, I have the AAA gas prices pulled up. I'm pretty sure I saw on Twitter, I haven't fact checked this, but that the gas prices have fallen for now 21 days in a row, a record since April of 2020. That was, of course, during COVID when no one was really driving anywhere. So gas prices were just falling everywhere. So this is just from AAA's website. Cool little chart and graph they have here. So a month ago, 484 was the average, or we'll call that 485. We'll round up. We'll round up to 485. Now it's 480. So 5 cents cheaper than it was a month ago. A week ago, it was 488. Yesterday, it was 480.07. Now it's 480. So if we keep seeing things like this, where prices are actually falling, and that is something that I think people need to be cognizant, be aware of, is the move from inflation to deflation happens very, very, very quickly. And I want to make that distinction here real quick because um, there's kind of this misunderstanding that prices need to come down for inflation to come down or to slow, which is not true at all. For inflation to stop rising, you just need prices to stop rising. So if that means that gas was going to stay elevated forever at 485 a gallon, fine. If it was 485 a gallon a month ago and it was 485 a gallon today and it was 485 a gallon 1 month from now, inflation would be zero because it's not rising. The price is staying stagnant. But that's not what we oftentimes happen. What oftentimes happen is you have inflation that leads directly to deflation. So instead of gas prices just staying where they were and inflation coming back to zero, no, it goes the complete other way, bullwhip effect, and you have deflation, where, yeah, exactly like Jonathan Lovelace is saying, same as stocks, stairs up, elevator down. And especially in this macro environment where you have fears of recession, you have consumers wanting to spend less as things get more expensive, whatever, just hit a breaking point where people are like, look, I can't afford $5 gas, whatever. It causes the companies to have to be able to bring those prices down. Otherwise, they're not going to sell gas. So to me, this is actually very, very promising for stocks if we keep seeing gas fall, because what does that mean? We've already seen a lot of different goods in the CPI have their inflation slow down or even some deflation in cases like home furniture, TVs, smartphones, electronics. What's really been causing the CPI to stay elevated and continue rising has been gas prices and travel prices, which are, of course, tangentially related to those gas prices, to those oil prices. Um, so to me, to see these gas prices continue falling is great, great news for stocks because these were kind of the last two things. These were kind of the last two things that I think need to fall in terms of gas prices and travel expenses to really bring that CPI down to a lower level. David Knight, no, trust me, I'm not like super freaking psyched that gas is $4.80. I don't want you to think that. I think it's a good sign. It's encouraging that gas right now is cheaper than it was a month ago and cheaper than it was a week ago. Diesel, as you can see, it's more expensive than it was a month ago, but down from last week's price. So, diesel isn't going to track regular gas exactly, but if you look at just crude oil or the West Texas Instrument, it seems like oil prices have been kind of moving lower. So, and that's the thing too. Easy Mike saying in the chat, pump price is different from actual commodities. One of the reasons different commodities are so expensive right now is because of oil price, because it creates, think about something like, well, wheat's not a good example because wheat obviously has the whole thing from Russia and Ukraine, but take something like oranges or orange juice. It costs more to ship the truck of oranges from Florida up here to Michigan, where I'm going to buy them because gas is more expensive. Now that makes the oranges more expensive. So seeing the oil fall down and seeing gas prices come down, will create all those commodities to fall. TS in the chat saying also borrowing costs for businesses has gone up. Yeah, and that's due to the Fed raising fund rates, raising interest rates. It costs more to borrow money. And it's the same for if you're a business. It's the same for if you're a potential homeowner going to buy a house and now your mortgage is more expensive. It's the same for if you go to buy a new car. Now your car loan is going to be a couple bucks more a month. And I did the math a couple weeks ago with the new interest rates. I mean, the average car loan has gone up like 30 or 40 bucks a month. Not a huge deal, but for something like houses, if it's going to bring your mortgage up from $2,000 to $2,500, now you have to pay an extra $500 for the same house than if you would have bought it a year ago. That's significant. That's a 20% increase. That's an actual significant increase. All right, guys, let me know in the chat what stocks y'all are watching today. I've of course been watching Tesla. The name of today's show is "Why Will Tesla Stock Keep Crashing?" And we just talked about it for a while there. Before we get to that point where we hit that capitulation, before we really hit the bear market, we do need to see some more pain. We need to see some of these things come down lower. I would be shocked, even though Tesla's deliveries were fine. I'd be shocked if Tesla is able to report a quarter that it shows that they're able to maintain its growth over the past couple of years. Um, Meta. Christopher is saying, I bet Elon is long Meta. Let's pull up Meta because Meta is interesting to me here. Not really as it's just to me like at some point this becomes a value play. Like the company has a lot of cash. It makes a lot of cash. It's a cash machine. And you got to think eventually investors start to think this is attractive. 13 forward PE, a price to sales of less than 4. So it's not like crazy cheap, but for a tech Silicon Valley company to see a less than 4 price to sales, a 13 PE, that is pretty cheap. Let's go to the chart here. Let's go to daily candles, get a refresh in here so our numbers load properly. Okay, so pretty decent day for Meta, up 2.7%. Let's check in on a weekly. I think we're right at basically our lows of what we hit, back in April. So I don't know. This is one that I'm not in yet. I do think I will get in this eventually, just because even though I'll say this about Meta. Right, and I think it's actually, you can give me any stock, and I can give you a bull case and a bear case on it. So if that's true, if any stock I can give you a bull case and a bear case, it's not about like which one is it's to me, it's about multiple things, right? The long-term story. And right now for Meta, the bear case for me, one thing I don't like about it is all this attention and money they're spending for metaverse. Like I just am not bought into that this is going to be the next big thing, that all gaming is going to be on the metaverse, business is going to be on the metaverse, even healthcare, like we're all going to be in the meta. No, I don't really buy that. I think it's a cool technology, but if I were Facebook, I'd allocate like 2% of my business and my R&D to metaverse and then focus on the other stuff. I mean, if you look at TikTok and you look at Instagram, Instagram is very much behind the ball on TikTok in terms of daily active users, downloads, just reach across the world. I mean, I think TikTok has more than 1 billion daily active users or something insane. And Instagram's trying to compete with TikTok. They have the Reels product, but it's just not the same. The algorithm isn't as strong. And you have to fight with YouTube too. YouTube has YouTube Shorts now. You have actual Facebook users declining for the first time like ever. You have WhatsApp, which is huge across the world. So you have WhatsApp, you have Instagram Reels, you have Oculus, and then now you have this whole Meta thing. I just don't think the story is like that. I think there are a lot of companies out there that are probably doing cooler things for the long term than what Meta is doing right now. But I don't just care about the story like that. So even though I'm bearish kind of the company's metaverse things and all that, I can be bullish in the sense that I can recognize from a fundamental standpoint when there's value in this stock. But one thing that can happen, and we've talked about this on the show before, is what kind of a value trap is and how that gets people stuck. If you're looking at a stock, if you're looking at the fundamentals and you're looking at the valuation and thinking, oh my God, this doesn't make sense, this is so cheap, and you keep buying it, and then those earnings get crushed because basically the valuations and fundamentals are lagging. They're based off previous quarters numbers. So if Facebook never puts up quarters like it did during COVID, then your whole argument about it being this crazy valuation goes out the window, because when you get those new numbers coming in each quarter, it actually lowers the share price. So I'd be worried about a potential value trap for Facebook here until I see let's see. Christopher saying, I think Meta has most of its share of online gaming. For a while, it had good things going with things like The Price is Right and Game of Thrones game I liked, but it has been lagging here. Yeah, I mean, if I remember Facebook games back in the day, like remember Farmville, remember there was one like mafia or mob one that everyone was playing and people were spending real money on it. I think that was one of the first cases um, where I saw a game have a lot of success having that kind of freemium model where, right, it's free to download Farmville. Oh, but you want to buy coins, you have to go, you have to go buy some coins. Oh, Aaron Bryan, I thought that was common knowledge. Like that was for sure the first use case of Snapchat was just to be able to send like lewd pictures and have them delete. Although Evan Spiegel, I'm pretty sure created the app as part of a project while he was at school at Stanford. So I can't imagine that he was able to go to class and say this is what the app was for. So maybe he had a different uh, reason for that school project while he was doing Snapchat. But yeah, definitely that was. But I mean, I think there's a lot of cases like that, Aaron, where there are companies like if you think about it, Facebook started as literally a hot or not website, like a college dating app. Like you would decide whether you thought people were hot or not. Now Facebook's way bigger than that. So I think sometimes companies start with one idea and they pivot and realize, oh, our technology or our company is actually pretty good. We can do more things. I've actually been watching, going back, and I don't know if anyone's seen this show on HBO. I know I've played a clip on it here before where uh, the guy in Silicon Valley, the show on HBO, was talking about how investors don't like revenue. They like pre-revenue companies because if you're a pre-revenue company, you can always be pre-revenue. You can always rely on that growth. And then once you report revenue, you need to report increasing revenue quarter over quarter, or else your stocks can get crushed. It's why Amazon never reported revenue or profit for like 20 years, and the stock always did great. I've played that clip on here before from Silicon Valley, but I've actually gone back and started rewatching it. And it's pretty interesting because I wish they would remake a new season of Silicon Valley and make it like all about crypto. I think that'd be really funny. Um, they should have focused on gaming at the start. That's the reason I made Facebook. Yeah, I think looking back on it, there are a few different things that Facebook probably I don't want to say overlooked, but maybe like dropped the ball on. And online gaming is definitely one of them. Because if you look at the popularity of websites like Twitch and just how much gaming has grown in general over the past 15 years, like since Facebook has been around, how much has Facebook gaming grown? Not as much of a, not as much of a, not as much as the overall industry has. The other thing is on the fintech side, Facebook. I mean, there are billions of like users around the world that have Facebook, Instagram, whatever. And a lot of those people don't really have banks or are underbanked. Like Facebook could have been everyone's Venmo and more, a place where not only Venmo is basically just for sending and receiving money, but, make it like a full-fledged fintech online bank where you can deposit checks, get a savings account, get loans, whatever. Facebook could have easily, well, I don't know about easily. There's probably a lot of regulation there, but that'd be an area where I bet if, we had some truth serum into Mark Zuckerberg, he'd say, yeah, maybe we could have invested more into like the fintech space 10 years ago, or maybe the online gaming space. And then, yeah, I mean, now it's just not the story to me for long-term growth. It's like, and who knows? Like, I could be completely wrong, and metaverse is the biggest thing in the world. And there's that, um, people always dunk on Robert Reich, the economist he worked under Bill Clinton and his administration as the Secretary of Labor or something. But he had a quote in like, or no, I think it was Paul Krugman. It was either Paul Krugman or Robert Reich had a quote about the internet being he's like, the internet is going to end up being as useful as an invention as like the fax machine or something. Just basically saying like, oh, in 10 years, like this internet thing is going to be away and it's a fad. I could be completely wrong about the metaverse like that, where in 10 years, everything's on the metaverse and I'm completely wrong. I just don't love it from a business standpoint. The fact that Facebook's investing this much into it, not just money, but this much, labor, time, R&D. And they've even said, like, I'm pretty sure Mark Zuckerberg has said, like, yeah, we're taking a big risk doing this. Like, we don't know what this looks like. Aaron Bryan saying he did and got kicked out of a Stanford event because the professor was like, you can't be pitching a sexy nap. But yeah, so hard to have morals and invest. Yeah, I would also just argue too that like Snapchat's case, like I wouldn't even say that's immoral. Like if people wanted to, if anything, if it was like trying to fight the problem of people sending pictures they didn't want getting out there and they would send it to someone and then that person they send it to would share those pictures, now Snapchat kind of solves that problem. I mean, not really, because people still screenshot pictures or whatever. But I think in theory, I think from like a moral standpoint, you could argue that Evan Spiegel could argue, oh, this is actually helping people because people are going to do this anyway. Um, they only hope is buying. Patrick? Who are you talking about? Snapchat or Facebook? If Facebook bought OnlyFans, I wouldn't hate that business move. I think OnlyFans makes a lot. I think that company makes a lot of money. Um, Funny thing is Facebook ended up doing payment to payment anyway. Exactly. Like that's the funny thing is like why not do it from the get go and be the leader? Because then you see other people start doing it, and then you're like, oh, I'll start doing this too. Trust me, there is a space for people to go virtually, to go to places like Disney World. There's going to be a big market for that. I'm not saying there isn't going to be a big market for the metaverse. I think it's really cool. I think it'll mainly be in that realm, in like the entertainment and gaming industry. And then at that point, I just think your TAM, your total addressable market for gaming and entertainment, isn't going to be as high as some people think it's going to be. Like when Mark Zuckerberg went on some talk show and they were like, "Oh yeah, we're going to be taking meetings in the metaverse." Like, I just don't really think so. Like, I think it just adds unnecessary complications to like why would I rather do a meeting in the metaverse than a Zoom call? I'm sure there are cases where it makes more sense, like, especially if I was like, okay, like I'm thinking about it now, like it would be cool to be able to tour like an apartment or a house in the metaverse, and you could meet with someone virtually and not have to leave your house and then know what the apartment looks like or whatever. Um, but I don't know. I just think that the total addressable market for metaverse isn't as big as Facebook hopes it is. And again, could be completely wrong. Um, I don't even hate Facebook, like going long Facebook here, because I think even if the market still continues to move lower, Facebook might end up being one of those flight to safety stocks where people are saying, "Oh my God, this company's making this much money. It's an established name. We're not investing in these like crazy other companies. Facebook is actually a decent name." Um, Maybe it's the thing of first one through the door is always the one that gets shot, and that is true in a lot of cases. So maybe Meta ultimately fails like Motorola and other pioneering companies. Um, Maybe it's the thing of the first one that is. So Christopher, sorry, I'm just trying to understand. So you're saying because Facebook is investing this much in Meta, that if Meta doesn't work out, Facebook is going to be the first one getting shot in this case? Um, yeah, I don't know. Let me know what you mean there. Let's do some quick checkups on the overall market before in a few minutes Rob Roy will be joining us on the Qs. We have gone green on the day for the first time all day. We are up 0.2% on the Invesco QQQ. The S&P 500 is down 1.2%. So tech is your leader today. The Dow Industrial Average is down 1.5%. So value Dow has been your laggard today. Tech been your leader. Qs, and it's not all like the tech you would maybe expect. I mean, Meta's having a great day, up 3%. Apple, I'm pretty sure, is having a good day. Apple's up about 0.7%. Tesla, which we've been talking about all day, is now green on the day, up 0.1%. But what's really been driving the Qs and the tech side of the market today is like growth. ARKK is up 5.7%. So ARKK, let's take a look at some of those biggest holdings in the actual ARKK. Roku up 7% today. Upstart, let's see. I don't even know if Upstart's a Kathy Wood stock, but I grouped them all together. Roku, Upstart, DocuSign. DocuSign is up 5%. Teladoc is up 4.9%. And then the last one we'll check, our good friend Zoom. Zoom up 6%. I see Buglog in the chat talking about Carnival Cruise Line and American Airlines. I don't know. I mean, I don't know if you guys saw over the weekend. I believe it was United or maybe American, one of the bigger airlines. A bunch of pilots were protesting. Wait, Christopher saying who was the first cell phone provider? Motorola, right? Basically a company that failed against Apple. Yeah, probably at one. Well, Nokia was probably the first big cell phone manufacturer, and then Motorola got huge in the mid 2000s with the Razr, was the most popular phone at the time. And then I want to say I feel like there was something even in between like the first iPhones coming out and the Razors. Maybe not because maybe yeah, because I want to say the Razors were big from like '04 to '07 or something, and probably right around then '08 or so is like when we got the first iPhone. But if you guys remember, the first iPhone didn't really do that well. It like was kind of a flop. And then after that, like the next iterations of the iPhone started to really do well. I don't think the first iPhone was received that well or sold that well. Could be wrong on that. Could be wrong on that. All right, guys. Oh, so basically what I was going to say about the airlines. So yeah, I don't know if you guys saw, but you had these pilots striking, protesting, and then basically flights have just been getting canceled all throughout. You know, I went on a rant last week about how these companies basically got bailed out during COVID. They said they weren't going to lay people off. They still laid people off. And they basically just I don't think have any need to really try to provide customers with good service, because if it's not like one is better than all the others, it's like you can buy a flight at Delta, Spirit, Southwest, whoever, and they all might get canceled. So you have no clue. You just got to buy and hope that your flight takes off. Airlines, perfect example. The first best airlines were TWA and Pan Am. Yeah, so Christopher, I'm just saying, okay, so you're saying first through the door in terms of like the first ones to get successful are going to be the first ones getting shot. I could see that, where like Facebook, like social media wasn't even a thing. Facebook was the first, well, MySpace, but Facebook really was way bigger than MySpace ever was. So Facebook was really the first big social network. Now they could be the first ones getting like absolutely crushed. TWA, that's the big Carl Icahn. There's some St. Louis history there too with the St. Louis airport. So I know that story well. Let's go ahead. I see our first guest hanging out backstage, Mr. Robert Roy from Wealth Builders HQ, going to be joining us today. I know it's a couple minutes early, so let's see if Rob's ready, if he gives me the thumbs up or something. Oh, he's giving me the double thumbs up. That means he's ready. All right, let's go ahead and give Rob our special intro, get Rob on the show, and see what he's been watching.
This.
Wrong video. Mr. Roy, how you doing today?
Good afternoon. It is afternoon, right? Yeah, it's not morning anymore. How you doing, Aaron?
I am good. You have a good holiday weekend?
Oh, it was fantastic. Busy, but we had a great time. How about you?
Yeah, I had a great time. Just hung out up here in Michigan, out on the lake yesterday. Went hanging out by the pool on Sunday. Yeah, just a pretty relaxing weekend.
The relaxing wasn't our thing. Sunday was my daughter's graduation. She got her master's as a teacher. So we had a party at our house, and 50 people crammed in our backyard. So that was fun.
Yeah, no relaxing when you're hosting a party like that.
Yeah, and our waiter staff backed out at the last minute. So the person we had coming to do all of this stuff, we had no one come anymore. So it came a little busy than we wanted it to be, but we had a great time. It was really a lot of fun.
Oh yeah, well, congrats on your daughter's graduation. That's exciting. Glad you guys had a good weekend. And now it's Tuesday, although it feels like Monday. And we're back. And we're back at it. We're back in the markets.
Back in the swing of things all over again. I know today is my Monday for me. Everything from Wealth Builders moves back a day when we're closed on Monday, which is our start of the week, of course, and our busiest day is Monday. So yeah, but markets are interesting as usual, right? What else can you say, right? I mean, we go from up to down to up to down, and we just can't seem to keep our heads screwed on straight. But it's pretty clear, right? So S&P was down. NASDAQ was up earlier today, right? S&P gapped down, ran a little bit further, is pulled back up again now. We're just hanging, but right now that 3,800 is an absolutely critical level on the S&P. We've got a confluence of the 8 moving average there. And if we back into it, confluence means you have more than one thing happening in one area, one zone. So we've got an 8 moving average, 100-point level, both very important. If we push there and fail, as we've attempted twice to break out, and if we could push into it and fail, it's another intraday opportunity. Today was tough because you just got a big gap down. It's a hard one to just say, well, let me go bearish it could be that head fake and we bounce back. So we're waiting to see if we can get a pullback today. On SPY, we didn't get a whole lot of opportunity on pivot points today because it was too small of a move, the potential. It made the move, but we're looking at 374 to 375.88. So just a little too small for me. The move up here of 376 up to 379, a little bit better. $2 is just a little tight on SPY. So from a market standpoint, it's interesting. VIX being down the last couple of days was nice, especially with the move we had last week. We were down 2.5 points on Friday. That was great.
Yeah, I think so.
Something like that, 2.68, 2.5. I forget exactly, but it's bringing us down to a more normalized for right now level. I'd still like to see about that 17 to 20. It seems to be for options traders. If you're a pure directional, I'm buying an option, man, you want like a VIX of 2, right? Because you want really cheap options. If you're a seller, you want high premium, right? But if you're trying to do both, somewhere about that 17 to 20 for me personally is where I tend to like the VIX a lot. Selling positions, my diagonal spreads become very, very tough when I've got a VIX of 12, 14. It's really tough to find good premiums.
Yeah, and I mean, that's right now what I find so interesting about this environment is that the VIX is like relatively pretty low for where we're at.
It is. The VIX hasn't operated the same since 08 that it had in the past, but it's still a good indication. It's the best indication, I think, that we have of volatility. But I think there's still some manipulation that takes place inside of it that doesn't give us the truest picture any longer, or as true as it seemed. How about that? From prior, but it's still the best thing we've got out there. And you're right, I agree. It does seem relatively low for what's going on. And I think there's just so much bullishness in traders just wanting it to go up, wanting that push. A lot of new money in the market. I think a lot of that is playing into it right now. Should not be, but I think a lot of that plays into it.
Yeah, and I think a lot of people are looking for that, like a lot of what I've seen is a lot of people, and these are people just predicting, they don't have a crystal ball, just like we don't have one, Rob, but they're saying that, to really get to that bottom and to get to that capitulation point, we'll need to see that, VIX come up a little bit higher, and that would mean some of these the indexes will have to move a little bit lower.
Correct. And we're not done. I mean, anybody that thinks we're done is crazy. If you're buying right now, and I'm not saying you should not be, but if you're buying right now, you need to be buying with the understanding that we're going to move lower and you're just buying a dip. You just don't know where that last dip is. If you look at what's happening, this is VIX, right? If you look at what's happening in here, we've got tops coming up. We've got our bottoms coming up. We have our tops holding in here. That's an ascending triangle. The expectation is a breakout to the upside. Now, this works slightly different than if I were looking at a stock. My break to the upside would be based on my initial move. Right? My initial move in the pattern is right here. Right? That's where the pattern runs. Many traders will tell you that the breakout on a triangle like this is 100%. So what that means is you're looking for a break to the upside of the same amount. Right? So another $18, when it does break, it breaks up by 18. And it very well might. I'm not saying no, it doesn't. It's too tight. It won't let me grab it. It's like, come on. Give me such a hard time here. Live TV, right? There we go. So roughly, that puts us up at a VIX of 55 if that ascending triangle does actually break to the upside and follow that 100% rule of where the triangle started. Which gives us, if we look at it, Aaron, right, if we take this back and get really old school on it, I mean, 37 has been crazy high numbers for us recently. Of course, here we had the 2019. But if we go back and look, I'm going to convert this to a monthly. Let's do weekly. Convert it to a weekly. Our all-time highs were back here in 08 on VIX. And 55 up here, with the exception of these two major breakouts in 08 and 2019, 2020, with the exception of those two, we've never been really
That's
above
almost surprising to me that the VIX was higher in 08 than it was in 2020, because I mean, obviously the macro outlook was worse in 08 and the overall market crash was way worse, but just the how quick the sell-off was in COVID would seem like the perfect environment for the VIX to be making all-time highs.
Right, but we had a lot more capitulation happening right up
Right.
front.
That's probably where you know, you had like Lehman blow up and Solomon Brothers and all of that. It's probably what that point in the VIX was.
Yeah, housing. I mean, I had somewhere I have statistics on this of how many people had lost their houses, how much money people were underwater. I mean, we had, you know, stock market education. You'll see when I have students show up at a live training we do, a lot of them are real estate investors as well, right? And they're looking for two sides. If they're smart, they realize there are times that real estate is awesome and you want to be buying. And there are other times that the market is awesome and you want to buy there. I'm talking about investors, not traders. And then you've got the real estate guys showing up, and how many people were so underwater, so much bankruptcies being filed, how many banks were calling the note that they allowed to happen, no less. They said, oh, wait, down payment? No, we're going to give you 105% of the value of the house. You gave it to me. Now you're saying, sorry, you're too far underwater. You've got to pay it off now. I can't. Or they allowed these balloons to take place. And I think some of that helped with driving that VIX up. But it is critical. And for anybody that's watching, if you guys can see it, you know, I'll do the best I can to kind of blow it up for you a little bit. But if you look on the right-hand side here, all of these blue boxes, these blue numbers here, those are my VIX levels. So if you want them, you're welcome to them. Take a screenshot, get your phone out, write them down, whatever you want to do. Record them on your phone, whatever works for you. But those are key VIX levels that I look at every single day. I call this the fear factor, because that's exactly what it is. It's driving.
Yeah. And so I saw a tweet earlier today, and I haven't fact checked this, but it's from someone who I think typically shares like pretty good information on Twitter, but said we've never had, or maybe in the past like 30 years, we've never come out of a bear market without the VIX going above like 40 or something.
Okay. I mean,
and that might just be what we're talking about in terms of like reaching that true capitulation point. Who knows? But I don't know. I really do think, like, with as much doom and gloom there is out there of people talking about recession, like, I don't think the macro environment we're in from an economic standpoint is anywhere near where we were at in 08, 09, or even the 2000 crash. So I'm still, like, trading wise, my trading strategy has kind of shifted a little bit while we've been in this bear market. But as far as investing, like, I'm still putting every 2 weeks when I get my paycheck, 10% of that's going into the market, the S&P 500 and other indexes. Like, I'm not, if I really thought we were going to crash another 30% from here, I wouldn't be doing that. I wouldn't continue to be adding there.
Yeah. I tend to buy more on the dips. So I wait for the dip, we get the bounce, I buy there. I wait for the next dip, we get the bounce, I buy there. I realize, you know, same as you, this is long-term, this is investing, not my trading portion of what I do. Trading portion, I'm in, I'm out, usually in the morning of the same day, I'm done with my trade. My long-term holdings that are not my investments, but a swing trade for me means I'm in a covered call for a week, or a diagonal spread for a week, or a credit spread for a week. That's long-term for me right now, is a week. But my investments, I don't mess with those, man. The strategies that we teach at Wealth Builders on, guys, it's real simple. Buy the SPY, sell your mutual funds, buy the SPY, and check with your advisor. I'm not giving advice, okay? Buy the SPY in your long-term retirement account, which is where I have most of my holdings for that, SPY, Qs, Berkshire, or in retirement. Go ahead and write a long-term covered call, meaning a year out in time, which means someone could buy the stock away from you at a higher price than it's trading for now, and then take that money and buy a protective put. It's called a collar. It's the strategy that you're doing. By doing that, when the market comes down and crashes 30, 40, 50%, you're going to watch your portfolio crash 8, 10, 12, maybe 15%, not 50, 60% that we saw happen in 08. And what we saw happen in 2019, 2020. We have a student that made 200% on that crash because of the way he was structured and not just leaving it sit in the mutual funds. So now I've never seen his brokerage statements. He's
in 07, 08?
In 99, 2000.
Oh, okay. So how were you trading 07, 08? Or were you, or did you just kind of like go all cash? Or what was your strategy back then?
Buying puts, put options, trading.
So were you making money in 07, 08?
You will make more money in a down market than you will ever make in a bull market.
Wow.
You know,
Yeah, and that's go ahead.
Yeah, sorry.
No, go ahead.
So this year, one of the programs that we teach is called Power Option Plays. We call all of the trades out and we run all the analysis based on did the trade fill or not, based on what we called out 2 times a week that we get together, right? Our goal is $100,000 a month, and that's on a $250,000 portfolio to start off with, somewhere between 180 and 250. Each year varies depending on what we need to start. That's going to change drastically on what we need to start next year once Google, Tesla, and Amazon are no longer, multi-$1,000 companies. As they are all doing their splits this summer, we won't need anywhere near as much to get going. But on average, the goal is $100,000. Here we are, the beginning of July. So the end of July, we should be at 700,000. At the beginning of July, we're already well over 800,000.
Holy shit!
Why?
So you guys are having a great year because we're in a bear market.
Why are we doing so well? Because our strategies are very concise, very precise on what we're looking to do. So much to the tune that I want to, if you're up for it, Aaron, I want to introduce a strategy that we finally have named and we're ready to rock it. And it's all free. We give all this stuff away, guys, by the way. Where in this, and I call it an inflation buster. In this market, it doesn't make a difference what the market does. As long as you know how to read that chart, you'll know exactly what to do with the trade and you'll have all of the details behind it.
Yeah, let's do it. I want to hear about the new strategy. We also have a good question from TJ in the chat saying, isn't it better to begin the collar trade when you are already up on the position? For example, when I'm up on the underlying stock, that's when I buy the put and sell the call.
So we're talking collar, TJ, on the S&P 500 on spiders, right? We're talking about retirement money. So what's the goal of retirement money? It's not the return on my money. It's the return of my money. You drop 50%. If you go from 100,000 to 50,000 in a portfolio, what does it take to go back up to where you were? Well, that's 100% gain to make it up. So we want to protect that downside. So by buying the protective put, I'm spending money. If the market rocks and runs to the upside, yes, I bought an insurance policy that I don't need. But I don't wake up on the 364th day of my car insurance due. I got one more day left and I got to pay it again and say, darn it, I haven't had a car accident. Let's do it today. Right? So I could use that insurance. We buy the insurance for catastrophe, not for a kid snapping off the antenna. Same thing here. We're buying it not because the market went down 10%. We had a correction. We're buying it or setting this trade up because of that long term. And when it does crash, and it will, the market will crash again after this. Believe me, it's going to happen again. We're protected there. So we may not make as much, but I am blowing away what mutual funds make when you start taking into account the fees that you don't even know about that are inside of there. Go and truly read a prospectus and look at the, what do you call them, B1 or B12 fees, which is advertising, your turnover ratios, which is almost 1% a year. It's huge what you pay. So, but yes, for a traditional stock, I buy the collar because when I'm trading it, I buy the collar because I don't want to have that position go against me and I'm willing to buy a put. So I tend to do that more around earnings dates personally.
Yeah, and so basically I think, TJ, what Rob's saying is that because they're doing collar trades on the S&P 500, the assumption is that you already have some exposure to the S&P 500 in your retirement accounts. Then you're hedging your already existing position. So, yeah.
Yeah, I'm not saying to start this trade now. You just had a car accident and you didn't have car insurance. You can't get it anymore today. It's too late. Right?
And like you said, I love that if you go a whole year without using your car insurance, you don't say at the end of the year, oh gosh, darn it, I never got in an accident this year. I just paid car insurance for nothing.
Exactly.
You don't say that at the end of the year. And just like with this, if the market is up 20% and you're making money and you lose, and instead of up 20%, you're up 17 because you were buying some puts, you don't say, oh my God, I lost out on that 3%. You're still happy.
1,000,000%. For me, that's it. It's just, how do I minimize my risk in the trade? I am soon to be 58 years old. My risk level, my tolerance has reduced because I don't have as much time to make it up. By trading strategies where I buy the SPY or the Qs, and I do the same thing with Berkshire Hathaway. I like Berkshire Hathaway, but you can do it with any companies that you like. I don't do it with very wide, let me say that differently, with singular focus. I'm not buying Amazon or Meta or anything like that to do this with. for long term. I am doing these on the portfolio, on the index itself, the markets. Couldn't get that word markets out. I'm doing it on the markets themselves mostly. Qs, SPYs are my two biggest holdings in my retirement account, right? And then every month cash goes in.
So with Burke, is it because with Burke you have kind of that wider exposure just to the overall, like you have so many, I mean, he has Geico, you know, you have this exposure to all these different things, not just one company.
Yes, it's a mutual fund without paying mutual fund fees.
Okay.
And
like
to a stock picker that is not relegated to, let me buy things that are going to make me the most money. It's let me buy things that I'm going to make the most money for my clients. I mean, when Warren Buffett gets up and starts apologizing because they had a bad year and, you know, we won't do it again and it won't happen again. And, you know, that's not what you hear from the market. Yep, we were down this quarter. It happens. Ask your broker. Did you apologize in 2008 to me when the market went down and you were telling me to buy more? You know, it's not happening.
Right.
That's why I like Berkshire.
Yeah. All right. So this is the new strategy, switchback trade. It's
called a switchback trade. The definition, right, as per Google, 180-degree bend in the road or path, especially one leading up the side of a mountain, which I happen to have a mountain trade here, but a mountain picture here. But if you follow along my mouse, we're kind of going up, and then you just literally flip 180 degrees. You go back the opposite direction. You go back the opposite direction, back the opposite direction. Okay. And basically what we've done here is if we look at, let me just get rid of those lines here. If we look at Micron was the one we did today, and we still have half of the position open right now. So let's see what that is. All right. So I'm going to bring this in, and here's what we're going to do. I'm going to bring this back and take today off of the chart. So there's a Fibonacci line right here, whatever that fib level is. Okay. That fib line, that red line that's in there is our support level. We closed overall clear to see. We're in a bearish bias. 8 moving averages, pink line, it's on the bottom. Green is up above that. Red is up above that. All 3 lines in the correct order, spreading apart, which tells me that the bearish pattern, the trend is in effect. It's strong. Okay. But now we're sitting at a support. And the question I've got to ask is this the place we're going to bounce? Is this the day, right? On Friday, I'm doing this analysis. Is this the day, right, that we're going to get a bounce to the upside, or are we going to continue to push down? How many times do you do your analysis and you're bearish today, and now you come up with all your answers of what you're looking for, all the trades for the next trading day, and the market moves the opposite direction? Like, I don't have anything to trade now. The switchback trade helps to avoid that from happening. Here's what I'm talking about there. We're sitting near a key level, near a support level right now. I want one of 2 things to happen right now. And Aaron, I'm just going to start a program up that will get me some drawing tools because we don't have anything in here that I know of.
Let's do it.
Yeah. Sorry. Usually I try to start this in advance. So I don't know. Are you seeing the 3, 2, 1 on my screen? Yeah, you are.
Yep.
Yeah. Okay. Yep. So that's just me getting my recording software. So let's do this. All right. So inside my recording software, I got some great drawing tools. So right here, let's say that this candle right now, we're just going to bring it all the way over here. Okay. So this is Friday's candle right here. Right. That's the wick of the candle. Right. Sorry, drawing with the mouse. So what am I looking at here? Okay. If we get a breakthrough on the next trading day of whatever this level is, make it down a little bit lower, come back up, retest, and fail, that's my entry. That's a pretty plain, straightforward trade. Bearish bias. It's definitely the way I would prefer to have this trade go, to the downside, right? But I realize that come Tuesday morning from Friday afternoon, that may not quite happen. What if instead, what if this stock will put the same candle, right? What if instead the stock does move down a little bit, comes to this level, and then bounces, right? If I get in the right place, not taking the entry, you know, on the open where it didn't get to move down of the next candle of today's candle, but allowing the move to a key level, right? The phrase, write it down if you don't know this. The phrase is clear and concise entry. You need a clear path to your next resistance level up here, and a concise entry. That is the concise entry for bullish. That is the concise entry, because my stop on this here, let me draw it again because it's getting a little bit busy. If this is our candle, right? And I decide to take a bullish entry here, my stop is going to be down here no matter what. Why would I not personally wait for the move back? And it doesn't have to get all the way to this line, but you want it near it. Take the entry here. And now instead of having $5 of risk, I have $2 of risk. I got in the right place. It's a concise entry. This is, traders make this hard sometimes where they want to put all these, I've got these graphs and custom indicators and all this crazy stuff that I've built in there. And I'm not saying that they may not be helpful to you, but if you can just get a pattern that works consistently again and again and again and again and again like this, and you'll see it, guys. The trade with Rob patterns, we were crushing it until Ukraine hit the war and the market started going crazy, and the whipsaws did not sustain in one of the original trade setups, which is a zero line breakout. They still work, just not as powerful as they were. I've got to have the really, really clear setup for me to take that trade. The inflation buster allows me that regardless of what's going on, it closes in an area close to a support or a resistance level as long as it moves. Which way? Up or down? Yes, up or down, as long as it moves the right way, which always requires, from where we were here, a move down to support and a bounce to take the entry. If we look at the same candle and we break, it has to retest and fail to take the entry. As long as we have that in place, that's exactly what you need. Right there, that's the clear and concise entry. Now, if I had moving averages in my way or something else happening here that didn't prevented me from taking it because it didn't have a clear path, then you find another trade.
I like that. Yeah, I think, like you said, like when you have that clear and concise entry, to me, those are the best strategies where you have because to me, it creates more of an opportunity to recreate those trades and do it systemically than if you have some like crazy strategy where it hits only one every 10 times.
I'll ask this question at events all the time. We look at candlestick patterns and the reliability. I look for high reliability candlestick patterns only, like a 3 outside up, a 3 inside down, things like that. Only high reliability. Well, what if I told you that there was a candle pattern out there that 100% of the time, 100% of the time, when that pattern presented itself, it did exactly what it was supposed to do? How many of you would get really excited about that candle pattern? Right? Of course you would. And there is one out there. I don't remember the name of it because it shows up like once every 10 years. Who cares? You know what's going to happen? I'm going to be driving through the Midtown Tunnel in Manhattan when that pattern presents itself. What am I going to do with it? It's not enough for me to want to take that trade. I need consistency. I need repeatability. I want high reliability, high repeatability, right? And high predictability. If I can get that in a trade setup, then I am golden.
Yeah. I mean, I think this is a cool strategy. I'm excited to see how, the type of success rate you're going to have with it.
Excellent. So 52.44 is support, Alan, right? Let's go, Aaron, sorry. Let's go over to Micron on today's chart. Intraday, okay? Here is my 52.44 level on a 5-minute candlestick, right down here, all right? So what happened? We gapped down, we blew through that level, and we took off. Now, let's take this same chart with that 52.44 level on it and turn it into a 1-minute candle. And what happened there? Let me bring it up as big as I can get it for you to see it, right? We gap down. We ran higher. We came back and retested and closed right here. Now, some of you are looking at it, but Rob, it didn't hit that line. So remember, the line is 52.44. Our low right here was 52.53. You're talking about 9 cents. The close was 52.55. You're talking about 11 cents. As far as I'm concerned, we didn't just hit it, we crashed into it. You're 11 cents away. That close allowed me on the next candle to take the bounce, and you could see how well it did. And our first target was just under that 55.47. So right about $55 was the first target. So I thought I had a line snapped on this one. Maybe it's on a different window. So $55, there is the trigger right at about 10:20, 10:19, 10:20 this morning. And you're out of the trade. You're talking about getting into an option for $1 and getting out of half of it. That's the first target. Half of it was $2.40. It's a $1.40 move on a $50 stock that you invested $100 into this trade if you did one contract.
Wow.
So over 100% return.
When did you decide you wanted to implement a new strategy?
I've been trading this strategy for about 6 months now.
Okay.
Just haven't come up with a name that I was happy with for it.
To teach it to your students and whatnot.
Correct. And all of my inner circle students, our mastermind groups, they already know this strategy. They're already trading it. They've been trading it for a while. But to release it to the masses, I'm actually releasing this to your group before I'm releasing it to my own.
Wow. You hear that, Zinger Nation? We get special treatment from Rob here where he's given us his new strategy before even his own room. I have thrown that link in the chat a couple times. I'm going to throw it in one more time. Tradinglikeaboss.com. Reverse FN is asking, did you give this call in your room, the micron?
No, because I don't do that kind of a trading room. That's not what it is. I would have actually released the strategy yesterday had the market been open at we do a 1 hour show every Monday at noon called Power Hour. You see it on this page. I would have released it there. Right. So no, but I did not. This was one that we took today, but not one that I sent out. It goes out to a private group occasionally. This one did not. Right. First day back, crazy day. It's a Monday for me. But guys, if you go here where the link that was dropped in for Trading Like a Boss and come right down here, Trade with Rob. Right. If you click on it, it'll take you over to the registration page for this. And this is it. Sign me up. Just give me your name and email. Tell me where you want it sent and we'll send it to you. There may be a place to drop in a text number if you want to text it to you. I don't remember if this is on this form or not, but it's real simple. It's free, right? I think they even have an FAQ in there. How much does it cost to subscribe to Trade with Rob, right? Nothing. It's all free, right? There's no cost to it. Guys, if I can get you to learn how to trade, you're going to stick around forever. And that's the problem. Too many people are innie outies. They're here now and gone tomorrow. They don't know what they're doing. They're blowing their accounts up. This type of trade will give you an opportunity to find a setup. And if it moves in either direction, the correct movement, you've got a home run there. Talking about 100+% today.
And this is one of those cases where, if you want to go into someone's room where they're just giving you trades, that's like, someone handing you fish. If you want to learn how to fish, you go to Rob's room where you learn these strategies for yourselves. So go to that tradinglikeaboss.com or what's the other one?
Tradewithrob.com is the other one for it.
Tradewithrob.com. Rob, we are running out of time. Time is flying when you're having fun. It's always great to have you on the show. Thanks a bunch for hopping on today.
Absolutely. Take care, everyone. Have a good day. Be safe.
All righty. Congrats again on your daughter's graduation.
Cool. Thank you. I appreciate that. Have a good one.
You too. All right, guys. That was Rob Roy. Go to tradinglikeaboss.com or tradewithrob.com. Go check out his rooms, like he said, completely free to subscribe. I'm going to throw both those links in there. Really a great resource to learn how to, like Rob said, to stay in the market. I see Christopher in the chat saying I often blow up my own account. Very frustrating. If you want to learn how to, not do that, Rob is your guy. Go to Rob. Guys, that will be a wrap for us today. It is 1 p.m. We will have Money Mitch coming up right now. The stream will automatically redirect you there. Money Mitch will be going through all of the biggest headlines and why certain stocks are moving. So make sure you stay tuned. Otherwise, we'll be back tomorrow, 11:30 a.m. Eastern. We will be doing Benzinga Live today, Tuesday, Wednesday, Thursday. Friday, we will be off. We are having our all-company Q3 meeting. So no Benzinga Live on Friday, but we will be doing one tomorrow and Thursday. Although Thursday, I may be doing it remotely, so it might be a little bit of a different look, but same show. All right, guys, please smash the like, subscribe if you haven't already. Give me a follow on Twitter if you haven't already. Aaron Bree 5. Love to connect with my Benzinga peeps, Zinger Nation on Twitter. Love you guys. Smash the like, subscribe. See you tomorrow.